Hello and welcome back. This is your host, Harshit Sinha, with the last topic on the ESG series related to the growth of ESG investing in India. The growth of environmental, social, and governance investing in India has gained significant momentum in recent years, driven by increasing awareness of sustainability issues among investors, companies, and regulators. ESG investing focuses on companies that demonstrate strong performance in environmental stewardship, social responsibility, and governance practices. With its large and diverse economy, India is witnessing a shift towards responsible investing as stakeholders recognize the long-term benefits of sustainable business practices. Regulatory efforts by the Securities and Exchange Board of India, such as mandating the disclosure of ESG-related information for listed companies, have further fueled this growth. Institutional investors, including mutual and pension funds, are increasingly incorporating ESG factors into their decision-making processes. India's burgeoning clean energy and technology sectors are also attracting ESG-focused investments. As global investors prioritize sustainable portfolios, India's role in the ESG space is expected to expand, making it a key player in the global sustainability movement. Now let us explore in brief the important points related to this topic. But before that, the viewer must be reminded that we are not going to do any assessment of the corporate entity, but explore the topic under a common heading. Now, what made foreign investment in India for ESG? It would be not wrong to say that the environmental, social, and governance factors are increasingly influencing foreign investments in India, contributing to enhanced foreign direct investment attraction, portfolio investments, and strategic partnerships. Investors are now prioritizing companies with strong ESG performance, viewing them as more sustainable and less prone to risks. India's regulatory frameworks, such as the Securities and Exchange Board of India guidelines on ESG disclosures, have bolstered investor confidence by promoting transparency. For FDI, international companies are keen on investing in sectors aligned with global sustainability trends, including renewable energy and electric vehicles. ESG-focused investments are also visible in India's capital markets, with a growing number of global asset managers incorporating ESG criteria into their portfolio strategies. Strategic partnerships are evolving as multinational corporations collaborate with Indian firms to meet global sustainability goals. This synergy is especially evident in sectors like clean tech, where India offers both market potential and cost-effective solutions for global challenges. Now let us look ESG funds in global context. ESG investing is still in its nascent stages in India, despite global growth in the sector. Globally, countries like the US, UK, and Canada lead the ESG investment landscape with over 500 ESG-focused funds each, showcasing the widespread integration of sustainability criteria into investment strategies. In contrast, India is gradually embracing ESG principles, with growing interest from institutional and retail investors. Globally, around 182 countries have at least one significant player in the Asian ESG market, indicating broad regional interest. Additionally, 119 countries are experiencing a rapidly expanding ESG investment sector, highlighting the potential for future growth. Among 23 countries, India, classified as an emerging market with significant potential for ESG growth, is gradually aligning itself with global trends. Initiatives like the SEBI's ESG disclosure norms and India's clean energy focus are key drivers of this shift. As ESG investing matures, India is poised to become an increasingly attractive destination for global investors. Now let us discuss about the status of ESG in India. ESG investing in India saw a major breakthrough in 2018 with the launch of the country's first ESG-focused mutual fund by SBI Mutual Fund. This marked the beginning of a significant shift towards sustainable investing. The trend gained momentum in 2020 when several prominent fund houses, including Axis, ICICI Prudential, and Quantum, introduced their own ESG schemes. The surge in ESG fund launches was driven by increasing investor awareness and the rising importance of sustainability factors in decision-making. By 2021, the assets under management, AUM, in ESG funds in India surpassed Rs 12,000 crore, signaling growing investor interest in responsible investing. Over 10 ESG funds were available for Indian investors by this time, offering diverse strategies focused on environmental, social, and governance criteria. The ESG sector's growth trajectory is expected to continue, with projections suggesting the AUM could reach Rs 50,000 crore by 2023, accompanied by the launch of new thematic ESG funds. Now we shall discuss the portfolio composition of ESG funds in India. This is shaped by a focus on companies that meet environmental, social, and governance criteria. Understanding the sector allocation of these funds helps shed light on the types of businesses investors prioritize based on sustainability and ethical practices. In India, financial services is one of the leading sectors in ESG funds, with banks, insurance companies, and asset management firms playing a significant role. These companies are increasingly adopting robust governance practices and focusing on sustainable finance, such as green bonds and financing for renewable energy projects. IT services also feature prominently in ESG portfolios. The sector's digital transformation and the adoption of green technologies, such as cloud computing and AI, contribute to improved environmental performance. Many Indian IT companies are aligning their business models with global sustainability standards, making them attractive for ESG investors. Telecommunication is another key sector, as firms within this space focus on reducing their carbon footprint and improving digital accessibility, which is integral to social sustainability. Pharmaceuticals represent a growing area in ESG funds due to the sector's focus on improving health outcomes and ethical business practices, including responsible manufacturing and drug pricing. Now we shall discuss about the growing emphasis on environmental, social, and governance factors in investment decision-making that has led to the emergence of dedicated ESG equity funds in India. These funds aim to provide investors with exposure to companies that demonstrate strong ESG practices, aligning with the global push for sustainable and responsible investing. As the image in slide shows, the 1-year and 3-year returns of the featured ESG equity funds have generally outperformed the Nifty 50 TRI benchmark, suggesting that ESG integration can potentially enhance investment performance. For instance, the SBI Magnum Equity ESG Fund has delivered 15.8% and 18.2% returns over the 1-year and 3-year periods, respectively, outpacing the benchmark's 12.9% and 15.7% returns. This trend highlights the increasing investor appetite for ESG-focused investment products in India, driven by growing awareness, regulatory changes, and a shift towards more sustainable and responsible business practices. As the ESG landscape continues to evolve, the future may see further innovation, increased adoption, and a stronger position for India as a global leader in ESG integration. Now we shall highlight assets under management, AUM, in India. The size of a fund's assets under management, AUM, can significantly impact its performance and expense ratio. Examining the AUM of the selected ESG funds provides interesting insights. The SBI Magnum Equity ESG Fund, with an AUM of nearly rupees 4,913 crores, is the largest among the funds featured. This substantial asset base can provide the fund with greater economies of scale, potentially leading to lower expense ratios and improved operational efficiency. The Axis ESG Equity Fund, with an AUM of around rupees 1,496 crores, is the second largest in the group. While not as sizable as the SBI fund, this still represents a significant asset base that can benefit from scale advantages. In contrast, the Quantum India ESG Equity Fund, with an AUM of just rupees 170 crores, is the smallest among the selected funds. Smaller AUMs can face challenges in terms of higher expense ratios and may have less bargaining power with service providers, which could impact the fund's performance. These variations in AUM highlight the importance of considering a fund size when evaluating its overall performance and suitability for an investor's portfolio. Now let us differentiate with ESG versus traditional investing. The comparison between the Nifty 100 TRI, traditional index, and Nifty 100 ESG TRI, ESG index, provides valuable insights into the performance of ESG investing versus traditional investing in the Indian context. From 2012 to 2020, the Nifty 100 ESG TRI outperformed the Nifty 100 TRI, indicating that sustainable investing strategies can potentially generate superior returns. This trend suggests that companies with strong ESG practices may be better positioned to navigate evolving market dynamics and capitalize on emerging opportunities. Notably, since 2020, the outperformance of the ESG index has continued, highlighting the growing investor preference for sustainable investment options. This shift is driven by various factors, including increased awareness of environmental and social risks, regulatory changes, and a growing consensus that ESG integration can enhance long-term value creation. The future scenario for ESG investing in India looks promising. The growing interest and commitment to sustainable practices among corporates, coupled with supportive regulatory frameworks, are likely to drive further outperformance of ESG-focused investments. As more investors allocate capital to ESG-aligned funds, the demand for such products is expected to rise, potentially leading to continued sustainable investing outperformance. The expense ratios are crucial in ESG investing, and we discuss here about it. The expense ratio is a crucial factor for investors to consider when evaluating mutual funds, as it directly impacts the net returns they can expect to receive. In the context of the selected ESG funds, there is a notable variation in the expense ratios. At the lower end of the spectrum, the Quant ESG Equity Fund and the Kotak ESG Opportunities Fund stand out with expense ratios of 0.64% and 0.61% respectively. These relatively low expense ratios indicate that a larger portion of the fund's returns are retained by the investors, potentially leading to better overall performance. In the moderate range, the ICICI Prudential ESG Fund and the Quantum India ESG Equity Fund have expense ratios of 0.9% and 0.97% respectively. While not as low as the previous two funds, these expense ratios are still within a reasonable range, allowing investors to benefit from the fund's ESG-focused strategies. At the higher end, the SBI Magnum Equity ESG Fund has an expense ratio of 1.34%. This relatively higher expense ratio may erode a more significant portion of the fund's returns, potentially impacting its overall competitiveness compared to its lower cost counterparts. These expense ratio variations highlight the importance for investors to carefully consider the cost structure of ESG funds, as it can have a meaningful impact on their long-term investment outcomes. Now we shall discuss the investment trends in environment sector. In 2022, the total investment by the top 100 listed companies in India was estimated at approximately R1.2 trillion, with a significant portion directed towards environmental sustainability initiatives. This marks a 32% increase in environmental investments compared to 2021, reflecting the growing corporate commitment to sustainability. Among the top 10 environmental investors, the average investment per company is nearly R50 billion, demonstrating the substantial financial commitments made towards green projects. Notably, these companies allocated approximately 15% of their average revenue to environmental initiatives, signaling a strong focus on addressing climate change, resource conservation, and energy efficiency. The increased environmental investments align with global trends of rising awareness and regulatory pressure for businesses to adopt sustainable practices. This surge in funding reflects not only corporate responsibility, but also the recognition of the long-term financial benefits tied to sustainability. The slide over here discusses the top environmental investment area. Renewable energy dominates the environmental investment landscape in India, with major focus on solar, wind, and hydroelectric projects. Companies are significantly investing in solar parks, wind farms, and hydroelectric facilities driven by government initiatives and reducing technology costs. Energy efficiency represents the second largest investment area, with companies focusing on smart grid implementation and energy-saving technologies. This includes investments in IoT-based energy management systems and energy-efficient manufacturing processes. Waste management initiatives have gained traction, particularly in recycling and circular economy projects. Companies are investing in waste-to-energy plants, plastic recycling facilities, and implementing circular economy principles in their operations. Water conservation and treatment receive comparatively less investment attention despite their critical importance. While some companies are investing in water treatment plants and conservation technologies, the overall investment proportion remains lower than other environmental areas. Biodiversity-related investments, including afforestation and habitat restoration, currently represent the smallest share of environmental investments. Despite their ecological importance, these initiatives often receive limited corporate funding, possibly due to longer return periods and difficulty in measuring direct business benefits. After understanding then priorities of investment in environment, now we shall discuss about the challenges in environmental investment. High initial costs present a significant barrier to environmental investments. Companies face substantial upfront capital requirements for renewable energy infrastructure, energy-efficient technologies, and environmental management systems. This challenge is particularly acute for small and medium enterprises. Regulatory uncertainty poses another major challenge. Frequent changes in environmental policies, varying state regulations, and evolving compliance requirements create hesitation among investors. This uncertainty affects long-term investment planning and risk assessment. The skills gap in environmental technology and sustainability management hinders effective implementation. Companies struggle to find qualified professionals with expertise in green technologies, environmental impact assessment, and sustainable project management. Return on investment, ROI, concerns remain prevalent. The longer payback periods for environmental investments, coupled with uncertain market conditions and technology risks, make it difficult for companies to justify these investments to stakeholders. Now we shall discuss what are the government initiatives supporting environment investment. We have also discussed in another presentation, but portraits towards the most confined government strategies, the National Action Plan on Climate Change, i.e., NAPCC, provides a comprehensive framework for addressing climate challenges through 8 national missions. These missions focus on solar energy, energy efficiency, sustainable habitats, and water resources, creating opportunities for environmental investments. The Production-Linked Incentive, i.e. PLI scheme, has been extended to include green technologies, offering incentives for manufacturing solar panels, energy storage systems, and other environmental technologies. This scheme aims to boost domestic manufacturing capabilities in sustainable technologies. Green bonds have emerged as a significant funding mechanism, with the government's Sovereign Green Bonds Initiative raising substantial capital for environmental projects. In 2023, India raised $2 billion through green bonds, demonstrating strong market interest in sustainable financing instruments. The future projections of environmental investments in the period of 2023-2025 is expected to witness a robust 40% growth. This surge is primarily driven by increased renewable energy adoption, stricter regulatory requirements, and growing investor pressure for sustainable business practices. While in 2026-2028, projections indicate another 40% growth phase in environmental investments. This period is likely to see accelerated investments in advanced green technologies, circular economy initiatives, and sustainable infrastructure development. The period of 2029-2030 witnessed a significant milestone, is anticipated with 80% of India's top 1,000 companies expected to achieve carbon neutrality. This projection aligns with India's commitment to net zero emissions and suggests massive investments in clean technology and carbon reduction initiatives. Overall, these projections indicate a robust growth trajectory for environmental investments in India. As awareness increases and technologies become more affordable, we expect to see a surge in corporate commitments towards sustainability. How let us explore the status of social investment, having the total spending of rupees 24,864 crores for the FY 2021 highlights significant increase from the previous year that indicating growing commitment to social investment. Of these, 37% was invested in education sector as the largest recipient highlight of CSR funds, reflecting the priority given to human capital development, followed by 16% in healthcare sector, the second largest recipient, highlighting the focus on improving public health outcomes. One of the important points observed during the 2021 was investment of rupees 1537 crores in the response of COVID-19 pandemic that was purely dedicated in the relief operation, thereby showcasing corporate agility in addressing urgent social cause needs. These figures from the Ministry of Corporate Affairs illustrate the substantial financial commitment Indian corporates are making towards social causes. The diverse allocation of funds demonstrates a holistic approach to addressing various social challenges. Continuing from the previous slide, we shall now explore impact investing, which has gained significant traction in India, with investors seeking both financial returns and measurable social impact. This model focuses on sectors like education, healthcare, and financial inclusion, with investments expected to reach $50 billion by 2025. Blended finance combines public and private capital to increase investment in sustainable development. This model has been particularly successful in funding renewable energy projects and affordable housing initiatives, leveraging government guarantees to attract private investment. Social bonds are emerging as popular instruments for funding social projects. India has seen several successful social bond issuances focusing on education, healthcare, and women's empowerment programs. Corporate venturing in social enterprises has increased, with major corporations establishing dedicated funds for social impact startups. This approach combines corporate expertise with social innovation, creating sustainable solutions for societal challenges. Overall, Indian corporates are exploring innovative financial models to maximize the impact of their social investments. These approaches allow for more efficient capital allocation, scalability of social initiatives, and alignment of financial and social returns. Now we shall discuss the emerging trend of collaborative partnership, first discussing corporate NGO partnerships have evolved significantly in India, moving beyond traditional philanthropy to strategic collaborations. These partnerships leverage corporate resources and NGO expertise to address social challenges effectively. Examples include technology companies partnering with education NGOs for digital literacy programs. Second, public-private partnerships, i.e. PPP, have become instrumental in scaling social impact initiatives. Government schemes combined with private sector efficiency have successfully addressed challenges in healthcare, education, and rural development. Notable success stories include rural healthcare delivery models and skill development programs. And the third is related to industry consortiums are emerging as powerful platforms for collective action on social issues. Companies within sectors collaborate to address common challenges, share best practices, and create industry-wide standards for social responsibility. These consortiums have been particularly effective in addressing supply chain sustainability and worker welfare. Lastly, one can say that partnerships and collaborative initiatives are becoming increasingly important in the realm of social investments. By pooling resources, expertise, and networks, Indian corporates can create more significant and sustainable impact. These collaborations also facilitate knowledge sharing and the development of best practices in social investment strategies. Lastly, we will discuss the future trends in social investment. Today, the landscape of social investments by Indian corporates is expected to evolve significantly in the coming years. Emerging trends include a greater emphasis on addressing digital disparities, aligning social investments with climate action, and developing innovative financial models that integrate social impact into core business metrics. During 2023-2025, there is increased focus on digital inclusion and skill development for the AI-driven economy. Here, there is increased investment in digital literacy programs, expansion of skill development initiatives for the AI-driven economy, and enhanced focus on bridging the digital divide in rural areas. While during 2025-2027, it was projected that the growth in climate resilience and adaptation projects as part of social investments. Growth in climate adaptation projects, social investments aligned with environmental sustainability, community-based climate resilience programs, and development of sustainable livelihood models are few activities projected. The period 2027-2029 predicted that integration of social investments with core business strategies, moving beyond CSR, thereby making integration of social investments with core business strategies, movement beyond traditional CSR approaches, development of impact measurement frameworks, and enhanced stakeholder engagement models. Lastly, in the period of 2029-2030 will shows emergence of new financial instruments linking corporate performance to social outcomes, which will confine more to introduction of social impact bonds, performance-linked social investment instruments, integration of ESG metrics with social outcomes, and in development of new impact assessment methodologies. Having been discussed about environment and social investing, now we shall explore investments through governance. Indian corporations are increasingly prioritizing governance investments as a crucial component of their ESG strategy. The average annual investment in governance initiatives by large Indian corporates has reached approximately rupees 500 crores, reflecting the growing emphasis on robust corporate governance structures. A significant year-over-year increase of 15% in governance investments across Indian companies demonstrates the expanding commitment to transparency, accountability, and ethical business practices. Notably, about 60% of Nifty 100 companies have substantially increased their governance investments, focusing on areas such as board effectiveness and diversity, risk management systems, compliance frameworks, stakeholder engagement platforms, and ethics and anti-corruption measures. Continuing from the previous slide, we shall now focus on the key areas of governance investment. Governance investment focuses on enhancing the structures and practices that guide an organization's decision-making and operations. Key areas of governance investment include 1. Technology. Investing in technology solutions improves transparency, data management, and cybersecurity, enabling better decision-making and more effective governance. Technologies like blockchain can enhance traceability, while artificial intelligence supports risk management and predictive analytics. 2. Board diversity. A diverse board, in terms of gender, ethnicity, and expertise, enhances decision-making by bringing a range of perspectives. Evidence suggests that diverse boards are linked to improved financial performance and better risk management. 3. Compliance. Governance investments in compliance ensure that an organization meets legal and regulatory standards, minimizing risks and maintaining its reputation. This is especially critical in industries such as finance, healthcare, and energy. 4. Training. Ongoing governance, training for board members and executives ensures that leaders are informed about emerging risks, regulations, and best practices. This enables proactive management and strengthens organizational resilience. Measuring the return on investment, ROI, for governance investments requires assessing both financial and non-financial outcomes. Key metrics include 1. Financial metrics. These are measurable indicators such as revenue growth, cost savings, profitability, and return on equity, ROE, that reflect the financial impact of good governance practices. Strong governance often leads to better risk management, improved operational efficiency, and enhanced shareholder value. Research shows that companies with effective governance frameworks tend to experience superior financial performance. 2. Reputation score. A positive reputation built on transparency, ethical leadership, and strong governance can enhance a company's brand equity and customer loyalty. Reputational damage, conversely, can lead to financial losses. Tools like RepTrack provide a quantifiable measure of a company's reputation based on its governance practices, helping track public perception and its impact on long-term value. 3. Risk indicators. Monitoring risk metrics such as governance-related legal issues, regulatory fines, or internal control breakdowns helps gauge the effectiveness of governance investments in mitigating risks. A reduction in these risks often correlates with improved organizational stability and lower costs associated with litigation or compliance violations. 4. Stakeholder feedback. Regular surveys and feedback from employees, investors, customers, and other stakeholders provide qualitative insights into the perceived effectiveness of governance practices. Positive stakeholder engagement can lead to improved morale, loyalty, and investor confidence, which contribute to long-term success. These combined metrics offer a holistic view of governance ROI, balancing financial outcomes with reputational and risk management benefits. Governance investments, while crucial for long-term organizational success, often face significant challenges. Here are some key obstacles. 1. Cost concerns. Implementing robust governance practices can be expensive. Companies need to invest in systems, processes, and training to ensure compliance and effective governance. These costs can be particularly burdensome for small and medium-sized enterprises, SMEs, that may lack the financial resources of larger organizations. 2. Lack of expertise. Effective governance requires specialized knowledge and skills. Many companies struggle to find qualified professionals who can navigate the complexities of governance regulations and best practices. This shortage of expertise can hinder the implementation of effective governance frameworks. 3. Cultural resistance. Changing established organizational cultures to embrace governance principles can be challenging. Employees and management may resist new practices, especially if they perceive them as burdensome or unnecessary. Overcoming this resistance requires strong leadership and a commitment to fostering a culture of accountability and transparency. 4. Measurement difficulties. Assessing the impact of governance investments is not straightforward. Traditional financial metrics may not capture the full value of governance improvements. Developing appropriate metrics and benchmarks to measure governance performance can be complex and time-consuming. These barriers highlight the complexities in realizing the full benefits of governance investments, demanding strategic planning and resource allocation. The future of ESG investing in India is classified in 4 different durations of time. First, for 2025. By 2025, ESG assets in India are projected to reach $300 billion. This growth will be driven by increased investor interest and regulatory support. Mandatory ESG reporting for all listed companies will enhance transparency and accountability, making it easier for investors to make informed decisions. Second, in 2030, the integration of artificial intelligence, AI, in ESG data analytics will revolutionize the way ESG performance is measured and reported. This will lead to more accurate and real-time insights, helping companies and investors better understand their ESG impact. Additionally, the launch of the ESG-linked bonds market will provide new investment opportunities, allowing companies to raise capital for sustainable projects. Third, in 2035. By 2035, ESG criteria will become a standard part of all investment decisions. This shift will ensure that sustainability is at the core of financial strategies, driving long-term value creation. India is expected to emerge as a global leader in ESG, setting an example for other countries to follow. And fourth, for 2040, by 2040, India will have a fully developed ESG ecosystem with real-time sustainability tracking across industries. This will enable companies to monitor and improve their ESG performance continuously, leading to a more sustainable and resilient economy. Here we end the last topic related, the growth of ESG investing in India, that is the last part of the series introduction of ESG in the India. In today's presentation, we have covered the introductory part of the topic, followed by discussion on the status of ESG and foreign investments in India and what is the status of global context and for India ESG Fund. This followed up by the brief description about portfolio composition among the top sectors and performance of ESG funds in India. Besides status of assets under management, AUM, and a short comparison between ESG and traditional investing was described. Besides status of expense ratios and investment trends was also discussed. Further, owing to the component of ESG, what are the top environmental investment areas and challenges in environmental investments were narrated and what provision was made by the Government of India in this regard. In the end, the future scenario of environmental investment projections was estimated. This followed up with narration of the status of social investments, innovative social investment models, collaborative initiatives and partnerships, and future trends in social investments. Continuing the discussion, the current investment trends in governance was discussed along with the key areas of governance investment, measuring ROI on governance investments, and challenges in governance investments. Lastly, what would be the future of ESG investing in India was briefly highlighted. What next? Now stay tuned, as in the coming week we are diving into a new series related to waste management with circular economy. Till then, I wish you a very warm season greeting with the emergency of winters.